Okay, so now I told you I would talk about a little more and explain a little more on the cheat area and what we call the turn. I mentioned the turn earlier, so I got to get you up to speed. Sometimes I'll say something I haven't yet explained it fully. So let's explain the turn, or what is the official change in trend. So sometimes you get through a pivot, but you haven't officially, what I call, made the turn and gotten back into a new uptrend. So what happens is you're in a stage 2 uptrend, right? And now the stock corrects. So you now go into a short or intermediate term downtrend within the longer term uptrend. What you're waiting for and what you don't want to buy until that intermediate and short-term trend now turns up, and you've got the long-term trend and the current chart pattern all in the same direction. So the earliest that you want to buy is when you get back into an official uptrend on the current chart pattern. So now, very simply, the way to do this is you look for a break of the downtrend. All right, and I'm going to show you examples in just a second. You break the downtrend, then you pull back, and then the high of that pullback is what, and that's a pivot in itself. And depending on how deep that this pullback is, if it's shallow enough and there's enough symmetry, well, then this would be a buy point. But this is what we call the turn. And this just simply means that the stock, once it takes out that high, it's now made higher lows, and it's taken out this high, and now the trend is now up on the current chart pattern, and now you've got all the trends in your direction. Now, the thing you got to be careful of is that this doesn't happen too quickly up the right side, and you get what we call time compression. Time compression is simply where the stock chart hasn't been allowed enough time to go through the natural dynamics of supply demand of stock changing hands, or that towel squeezing. You haven't let the towel wring out all the water. So you don't want to buy the stock or the towel, if you will, when there's still a bunch of water in it, because now you've got still a lot of supply, and the stock can't take off and make a big move, or the probability is a lot lower because you've got this supply that will hold it back. You've got the trapped buyers, you've got the profit takers. That has not gone through the natural dynamics to be able to weed those short-term holders out, to now let the longer-term players come in and explode the stock when there's very little supply. So now you got to let that right side build. Let me show you how that looks. So, and Dave just said this before with, I forget what page it's on, but the stock that ran up the right side, and said that that's not ready there because it ran right up the right side. Here's a perfect example where you run right up the right side here. And even though this comes back and maybe this looks like, it's contracting, it's still, this is a compressed right side. It hasn't had the time to go through. And you see here, you start going through, and now you're getting more and more tightenings. And Dave, this might be a time also to talk about fractals, because these tightenings really, are sort of a lesson in fractals, right?
Yeah, well, a fractal is a pattern within a pattern, and what you might see is you see a cup and handle forming on the daily, and you can even take that down. You might see a cup and handle within the handle if you take it down to a 30-minute or a 15 or a 10-minute chart. So sometimes you see that, and I mean, you can kind of on the right side here, it's really a cup and handle, but then you have another little cup and handle at points 3 and 4. You have one there, and so it's really a pattern within a pattern, and that seems to show up many times.
Yeah, and you have right here. What's right here? That's a cheat area, right? And then my little drawing tool here, and then you set up right here, and you got another pivot point. So you got a buy point here, and you got a buy point here. And now if we draw this line all the way across, you see there's very little supply. There's very little trading that occurred above that price, but you do get that lower buy point there. And again, we're going to go into this more and more and more and deeper and deeper and deeper. So don't panic here. You may not be, you might be saying, what is he talking about there? What's he drawing all these lines? Don't worry, we'll get you there. So again, here, take a look at Troy Group. This stock just exploded, 146% in 14 days. A great model of a super performance stock. See here where it comes and it runs right up real quick, and it's a little volatile here. See, it just hasn't put in the time yet. So now I wouldn't be considering this stock just yet. This just isn't ready. This doesn't, as Dave said, this doesn't have the look, right? But now it goes through more iterations, and now another, and you have that little pattern within the pattern. Like Dave just said, you get there's a little cup with handle here within the larger cup with handle, and you see, and now you're really tightening up, and you've got some symmetry, and all the elements are coming together now, and now the line of least resistance is forming, and that's why the stock, see, in all this time, the stock never comes out and explodes out. But notice how when you finally get the full right side development, and you get of all the characteristics come together right to that specific point, bang, it comes right out and it takes off with such efficiency. And this is, people wonder how I've racked up, huge returns over the years. And with the low drawdowns, it's timing. It's timing. You notice how when you get it right here and these stocks come out perfectly, there's little downside. You're at a profit right away. The stock is off to the races, and I'm selling, even into this first move, I might be selling some of my position, and then I'm cushioning my downside. So I'm getting my cake and eating it too. I'm getting that big move, and then I can take some of my profit, and I can now backstop my gain, and I'm free rolling the trade. We'll talk about that in risk management and position management later on. Go ahead, Dave.
One thing I'd like to point out too is that where you say too early compressed right side, the stock might have some of the characteristics, and maybe it had the earnings, but the pattern hadn't set up yet. Sometimes it's such a shame where you're looking at a stock, and maybe you bought it where it said too early compressed right side. Maybe you bought it and then you took a loss on it, and you said, I don't want to pay any more attention to this. And then you forget about it, and 2 months later, the thing breaks out and has this huge move. That's why you should have a list, and on MarketSmith, you can create all sorts of lists, and you check them every week, and to see if it's setting up again. Because boy, if you had been on the stock too early and then forgot about it, look at the move that you would have missed.
Yeah, actually, Dave and I we keep a list of stocks that we sold and stocks that we got stopped out of. We actually keep a list on our screen, and we look at that periodically, or I look at it pretty much every day. I look at the recent stocks that knocked me out and see if they've reset, or because sometimes they have all the characteristics. And this is something that I call stock right, not price ready. You can have a stock that's the right stock, but it's not price ready. Price ready is when you're going to buy it at that point where, like I said, the right price, not the lowest price. You want the right price. You want the right stock, but sometimes it's better to have a stock that's not a great company, that's price ready. It takes off, it makes a big move. And meanwhile, some quality company that is a great company, but it never sets up. It never gets into the stage 2 uptrend. It never sets up the pivot point properly. It's too volatile, and it knocks you around, and you can't ever make any money in it. So real important is price ready, as Dave is alluding to here. So again, we looked at this MGA before, and you see correct buy point is on the right side right here. See, that's the right price. Right? Not the lowest price. That's the right price. And we don't know, you could say, well, what if I bought it down here? Well, that's great if we had a crystal ball, but we don't know that this stock is going to take off up this right side. And we don't even know if it's going to set up. So we've got to wait. We've got to wait to make sure that all these elements come together and we get that low risk entry point. Here, again, 140% in 3 months. This is what you're looking for, and if you're going to look, even if you're going to hold for a bigger move, it would be nice to be up 140% in the first 3 months, right? That really gives you a lot of options. I mean, you can sell some, you can backstop, there's all kinds of things you can do. Once you're up 140%, you have a lot of options, because you're nowhere near the loss column at that point. So you want to allow you always want to allow right side development. I'm never buying a stock unless the right side is developed, and I'm getting that pivot point. I'm going through those contractions. I have that volatility contraction, and then that's the earliest that I'm going to buy it, is when you come and you get that change in trend, and then the pullback, and then breaking above the pullback high. That's when you are now, the stock is now in a new uptrend on the intermediate term level and the short term basis, in already a stage 2 uptrend. Let's take a look here at, go back again to Sarah's logic. So let's say we didn't have the benefit of looking at the handle phase and seeing the cheat, right? Well, this is what we would see before we get to the handle. Remember, the cheat has to come before the handle. You're watching these stocks in real time. So before you ever get to that, you don't know if this is just going to come ripping out and not form a handle. So you're going to be entertaining that right here, and as it comes through the cheat area. So again, you draw a line through here. Yeah, you've got a little bit of supply on the left side, but not much. It's only trades there for a few days, and the decline is not that great. See, here's the other thing about, I want to back up just a minute and talk about overhead supply again. So some people say, well, why would I buy that? Because, you know, there's overhead supply. Okay, well, if the decline was 60% and there was all this trading and it went down for 3-4 months, and now you're forming a cheat down there, that's no good. That's why Dave said we stay away from those stocks that are down 50-60%, because now you have to go through all those trapped buyers, and now that profit taking up the right side, and you've got all that overhead supply. This stock only came down just a little bit. If it comes down 10, 20, 30%, that's fine. And again, depending on how far away the supply is, if there was a lot of supply, you now have to have a big base to clear out that supply and move way over to that right side. On a shallower base, you don't have to have so much time, because you're going to clear it out, because you don't have you don't have as many trapped buyers, and there's not as big profits coming off the low. All right, let's move forward and take a look. So here's the cheat. There's your cup completion cheat. So we buy here. All right, maybe we buy part of the position, and now we can pyramid up, or we buy the whole position. Now we go through this pullback, and it should have never stopped you out. It hasn't even barely gone below the purchase price, and it sets up even better. This is even a better looking stock chart now at a higher price. Okay, at a higher price, it's a better looking stock chart. So now you get another buy point. So this is the 3C, right? Cup completion cheat. This would be the handle phase. Both of them, very important, both had VCP characteristics, right? This came down 1, that's a 2, right? So now you come back up here, and now you go through a couple iterations, and maybe you could serve 2, 3, 4. But again, all within the base. Another thing that a key point is that we're not buying once it comes out of the base. That's it. We're trying to come up with as many buy points as we can within the base structure to be able to have all those opportunities, because we don't want to buy it. Once it goes up, it starts getting extended. Now that volatility comes in. We're buying from very low volatility buy points, because that's where we get that low risk entry. Once the stock breaks out, Dave, once the stock breaks out of a base, you're not chasing it up. You're not buying it once it's going. No. Some people think, this pyramiding means that if the stock goes up 10%, you buy more because it's going up. That's not what that means, right, Dave?
Yeah, no, you want to time it as closely as possible to right when the stock is moving out. Once it gets, I would say it used to be 10%, but once it gets 5% from that buy point, you have to stop. You have to stop buying. You can buy again only when it goes up and it forms another VCP. So you can add to it, but not, you don't want to get the position too big right at the beginning. You have to have some money management techniques and let it go once it's broken out.
I almost never buy more than 1 to 2% above the buy point. I try to keep it to 1. Occasionally I go to 2, but I'm never buying it up 3, 4, 5% above the buy point. If I either buy it right at the buy point, or if it takes off, I leave it alone. Sometimes they move too fast and you can't get them, so you let them go, and you got to get rid of that fear of missing out and just look for the next one. So here's Baidu. All right, everybody knows Baidu, right? So again, you got a cheat right here, right? It came out, and then it made what? the turn, right? So once it breaks that downtrend, marks up, pulls back, when it gets above that high, that means that it's now, the stock is now, and I'll get a little drawing tool here, it's now in a new uptrend. You see, this is the downtrend, broke the downtrend, and now as you mark up, the break of the downtrend is not a new uptrend. It has to first pull back and then turn up and take out the high of that pullback. That's the key. And that is what I call the turn. Again, a lot of this vernacular, things that I'm saying, you're not going to hear anywhere else. These are my term. This is my terminology. At one time, a lot of this terminology nobody used. But since I wrote books and have done seminars, you can go on YouTube and there's all kinds of videos on a lot of this. But still, I haven't heard too many people talk about the turn. That's one thing that hasn't caught on as much. But again, the turn is simply getting it back into an uptrend. Now you get the handle, and now you've got another buy point to either add, or if you missed the cheat, or maybe you weren't so confident at this particular time, and now you're buying, you can buy it here. All right, then it moves up, and now you're going to leave it alone. Okay, another one. Let's take a look here. Microsoft. And now here's another thing too. Here's another caveat, if you will, or a tip. The larger the companies, when you get to the really large companies, I like to look for cheats even more than the small caps. You could let set up right at the highs and wait for full development, because they're not followed by very many people. There's not many analysts following them. Most people don't know them. So they're still very inefficiently priced. But when you get into the big companies, like nowadays, the Amazons, the Googles, by the time they get to new highs, you got a lot of eyes on a lot of retail money, and you get a lot of noise. That wringing out of the towel and getting all that volume out, sometimes it's hard to do with a name that has a lot of sponsorship, many, sometimes thousands of institutions in it, and all types of retail trading. I try to look for, especially coming out of a bear market, I look real carefully for these cheat areas in the bigger names. Microsoft was a perfect one that was coming out right here. I actually bought it right here. It came through this level right here, and you can see again, there's where you draw your line, and you can see it comes through that pivot point, and then it forms a classic handle. And this is just a big cup with handle with a previous cheat buy point. Again, looking at Zillow. So Zillow set up perfect with a 3C, and you see, you don't really get a handle. I mean, you can call this a handle, whatever you want to call them semantically, but we're just looking for buy points on the right side that are volatility contraction patterns. And this set up really nicely, nice and tight here. And you see how efficiently it comes out. Boom, right out. It was up in the first 25 days, up 68%, in 12 months, up 182%. That's the kind of stock that you're looking for. Let's look at another one. We looked at this before. This was Green Plains. Sometimes you'll get a cheat, and then you'll get a setup a little bit later. Sometimes, a base on a base where it's almost adjacent to it, and now you get a handle, and you get another buy point. I'm just going to show you, a bunch of examples here. Another one here tightens up real tight on the right side. 6 months, 98%, 100%. Now, you ever hear the commercials? Wait, there's more. Well, there's more. There's actually even a lower buy point. So when I told you I first started, and I started noticing the cheat area, and that there was a lower buy point that was high probability it was working. I find, and I get a question all the time, what's the percentage of success from the cheat versus the handle? They're about the same. It depends on the market environment. Some markets, you do better from the cheats than the handles, but they're about the same. In my experience, I found that the cheat is actually even a little bit higher probability.